in our mid-year outlook this morning. I hope you're all enjoying the summer. It seems like it's flying by anymore, and I'm not sure whether that's the time flies when you're having fun or because I'm getting old and the years seem to be flying by. But anyway, it's half over. I hate to call that to your attention. At this point, I'm going to turn over the time to Patrick Morrell, our investment strategist. And keep in mind that all attendees will be muted, so we don't have to compete with each other. But you do have the tools in your little control box to be able to take advantage of the raise your hand function, or you can type in a question and we'll insert it, and Pat will jump right on it. With that, Patrick, would you take it away?
Absolutely. Thank you very much, Corby. And I'd like to welcome everybody to our mid-year outlook call today. If you spent some time tuning into calls that we've had in the past or dialed into our annual outlook this past February, we're going to be going with a similar theme and format as we had presented with you earlier this year. And that's really providing you an outlook on not only the U.S. economy and the global economy, but also touching on areas of the stock market and the bond market, all in the form of a farmer's almanac. And so we'll call that an investor's almanac. And so you'll see a lot of pretty pictures and gauges and crops and farming-related materials as we walk through. And what we're essentially going to try to do on today's call is kind of reaffirm some of the things that we had shared with you earlier this year, bring you any new information about the economic or investment markets that we haven't yet brought to you, and try to answer any questions that you may have regarding not only your own investments in your 401k, but some other things that you may be seeing, reading, hearing, going on in the marketplace today. So, please, again, as Corby had mentioned, please feel free to use the raise your hand function or use the chat function with the webinar. Get those questions out there. I'm happy to entertain any questions that you may have. So we're going to start with a very basic first slide, and that's what we'll call the notes from the field. If you had tuned into our call.
1 second. We've got a question from a participant here, and I just want to unmute them to make sure everything's working okay. Stan, you had raised your hand. You're unmuted. You can go ahead. Maybe it may be a false alarm. Do you have a question, Stan? Okay, I'm going to lower your hand for now, and if you have another one, just go ahead and raise it there. Sorry about that, Pat.
Just testing the features.
That's right.
So what we're looking at on the first slide here is what I'll call our notes from the field. And if you had dialed into our call in February of this year, really what we had anticipated would happen in the U.S. economy was continued moderate growth in terms of gross domestic product, or GDP, and that essentially measures how quickly or slowly the economy is growing. We expected that moderate pace to be around 3 to 4%, about a 1% higher rate than we had experienced in 2013. We were also expecting stocks to increase in value by anywhere from 10 to 15%. We broadly called it low single-digit returns. And we expected rather flat returns within the bond market, and that was primarily due to our fear of rising interest rates, very, very small yields or returns that are being presented with bonds today, and the overall fixed income environment in general. So that was our outlook then. As we progressed through the first 2 quarters of this year, I think everyone is kind of a little whipsawed from what we saw in the first quarter and kind of how we fared in the second quarter. I don't know about you all, but I spent a lot of time in the Northeast and some of the Midwest states early January, February of this year, and most Americans there were snowed in. Spent a lot of times in their homes, didn't purchase a lot of goods, didn't buy a lot of gasoline, and so what we saw in the first quarter was a very slow-growing economy. We actually saw the economy shrink for the first time in 12 quarters in the first quarter. And that was primarily due to, again, most of the weather that we had experienced across most of the Midwest and Northeast states. So that weather-induced slowdown in the first quarter really set the stage for a really good 3 months that we've just experienced ending in June. The second quarter fared much better. We had a lot of businesses spending more money, a lot of inventories being restocked. We saw new car purchases and new home construction permits ballooning really in April and May of this past year. And really what we saw there was pent-up demand. So while we saw a shrinking economy in the first quarter this year, we saw an expanding economy in the second quarter. So we still believe, tying back to our assumption of 3% GDP growth, we still believe we're on track to achieve that level of annualized growth of 3% as we progress throughout this year. The government will release another read on gross domestic product next Wednesday, the 30th. So we'll get an idea of how much the economy actually grew with their initial read next week. But suffice to say, we saw the economy picking up quite precipitously in the second quarter, and that in turn fueled a better stock market. We saw stock returns in the first quarter, relatively modest, anywhere from 1 to 3%, depending on the area of the market you're looking in, large caps, mid caps, small cap stocks. But the second quarter saw a much quicker or faster pace of growth in U.S. stocks. By early June, the stock market was up almost 6%. That's about a 4 or 5% growth from where we were in the first part of this year. And really what that tells us is that if we're at about 6% halfway through the year, then again, we're on track to hit that 10 to 15% growth in stocks as we had anticipated earlier this year. The bond market was not relatively flat. We actually saw some positive returns in the bond market, not as high or as quick as the stock market, but we did see some positive gains. In the first quarter alone, we saw bonds up almost 3%. We saw a slight detraction in the second quarter, but suffice to say that high-grade bonds, high-yield bonds, anything without that government flavor to it really performed much better than the government bond counterparts. We'll talk a little bit more about that as we proceed in the slides. So really, it's important that we take a second to really explain where we are. Again, we've got moderate growth in the economy. We've got a well-performing stock market and a flat bond market. And that's really all characteristic of where the whole U.S. economy is in the business cycle. So if we look at the slide on the screen today, there's really 4 different cycles that we look at or we can categorize our economy in. It's in a recessionary environment. There's always that early recovery coming out of the recession, the middle or mature stage, which I believe is where we are today, and then the late aging stage where prices are getting a little bit inflated, things are getting a little bit expensive, and we may be heading again back toward that recessionary cycle. Similar to weather patterns, similar to crop cycles, similar to business cycles across many different sectors, not only the economy but individual businesses go through these same types of cycles. And so we find ourselves today in that middle mature cycle. Again, characterized by moderate GDP growth as we're experiencing today, a slow rate of inflation, which we can talk about a little further in the presentation, normalized federal monetary policy. We'll certainly touch on that as well, but as we have seen over the past 2 Federal Reserve meetings, the Federal Reserve Bank is becoming a little bit more hawkish in their view on spending money toward bond purchases and on keeping interest rates low. So we're starting to see the Fed be more apt to be toward a normalized monetary policy for the U.S. economy. And so, again, with those 3 factors in mind, we should see interest rates begin to rise. We should see a steepening of a yield curve, which means that rates are going to start to normalize and more market forces are going to generate interest rates for different types of bonds rather than having those pegged by the Federal Reserve Bank. The middle to mature stage also sees double-digit gains for stocks, and it sees heightened volatility. And part of the reason for that is that people feel more confident about the economy. People feel more confident about their jobs, about businesses, about their own bank accounts and their own spending patterns. And so when you see a little bit more confidence in consumers and in spenders and in business leaders and business owners, you'll see essentially more risk-taking, More risk-taking by buying stocks, more risk-taking by expanding their businesses, by taking out loans, by leveraging themselves a little bit, and so with that comes volatility. What we'll see in some of the slides is really how we can take advantage of not only the cycle that we're in today, that middle mature cycle, but you know, some opportunities we may have in the stock market, as well as taking advantage of some volatility opportunities. So consistent with that kind of middle of the cycle position that we're in today, we typically are going to expect that moderate GDP growth. So again, we're anticipating a, call it 3 to 4% growth rate by the close of this year. And it's also oftentimes the middle or mature cycle of the stage is a turning point for inflation, meaning people become more confident, they start to spend more. As people spend more and borrow more, you see prices start to rise. And not just in certain areas of the market like gas prices or home heating oil, but we're talking prices across the board in terms of transportation, in terms of housing, in terms of clothing and apparel, food prices. So this is something that you know, we've been mindful of for the past several years. When is inflation going to kick in? When are prices going to rise? This is more or less the point where we're starting to be a lot more observant of those inflationary pressures. This part of the cycle also invites federal policy to typically change. You know, the Federal Reserve is almost like operating an ocean tanker or an ocean-going ship, in that, you know, when you're charting your course to get from point A to point B in that container ship, you're making decisions on when to turn, on when to increase speed and when to slow speed, miles and miles before you actually need to do it. And that's kind of how the Federal Reserve is steering the economy. They know where they need to be, and they know the tools they have to get there, but the decisions that they make today really affect us a year down the road, or even 18 months down the road. So at this point in the stage, you'll see the Federal Reserve Bank really start to say, okay, we've done a lot of things over the past couple of years to really try to re-energize the economy. This might be a turning point where they say, let's adjust our assumptions a little bit. Let's you know, adjust some of the tools that we're using a little bit. So you may see some Fed actions change. A result of that, as the fourth slide, or as the fourth bullet point indicates, is that we do expect the Fed to continue decreasing its bond purchases and really end this whole idea of quantitative easing by the end of the fall. And what that means for investors or for business owners is that as QE wraps up by the end of this year, the next real monetary tool that the Fed's going to focus on are interest rates. Whether or not to keep that short-term interest rate at 0 and near 0 rates, or allowing that interest rate to rise by 1/4% or 0.5%, or even as much as 1% over the course of a year. Normalizing those interest rates are clearly going to affect business owners, are going to affect investors and consumers, but it should allow for a little bit of cooling of the economy so that we don't quickly move through the mature stage into that late aging stage. Given where we are in the cycle and certainly what we've experienced in our own portfolios over the past couple of years, we'd like to take a look at really 3 different categories of investments that we consider either sowing the seeds, meaning let's start to add to a little bit of our portfolio to these different areas because we feel they're in the early stages of growth. We've got the full bloom stage, which are really investments that have been working or have been working over the past several cycles, and maybe what you want the bulk of your portfolio to look like today. Harvest time are those securities that have again gone through that mature stage, and it's really time to start looking at harvesting some gains or taking some risk off the table in these specific areas. We'll start with sowing the seeds and kind of quickly move through each of these categories, but we really do like the international developed market stocks, and for the reasons that they're essentially, as a whole, and it obviously depends on the region and the country that you're seeking, but as a whole, the international economy has strengthened at a level that the U.S. has since our recession in 2008. I'd say that most foreign countries are about a year, 2 years behind where the U.S. is in our recovery, and so you're seeing more political stability, more stability in monetary policy in countries over in Europe. You're seeing some cooling down in China or some of the emerging market countries, and really what that means is that you've got opportunities in other areas outside of the U.S. where they're much more in the development stage, we're much more in the developed stage. We looked at some other fixed income alternatives. So government bonds, which are, for the most part, pretty range bound in terms of what they can offer in interest rates and return. Fixed income alternatives will allow investors to get yield or get return elsewhere. Things like floating rate banknotes, senior subordinated debt, some different types of high yield bonds, global high yield bonds, emerging market debt. We call these types of fixed income categories, call it fringe categories. You know, the categories that wouldn't be the core of your fixed income portfolio. They would be additives to your core fixed income portfolio. We think that these fringe type categories right now can offer you some diversification benefit, some additional yield opportunities, maybe even dampen the volatility on your overall portfolio. If we look at securities that are in full bloom, these are some of the things that you've probably seen in the headlines or in the Wall Street Journal, USA Today. Large cap stocks. U.S. large caps have been one of the best performing security types coming out of our most recent recession in 2008. Companies you know like Caterpillar, General Electric, Ford. These are companies that really position themselves well to come out of that recession and increase sales, increase exposure, and not only sales here in the U.S., but most of these U.S. large cap stocks are globally diversified. Procter & Gamble, a lot of these companies you're seeing over in Europe get big or expanding their markets over into Asia. So they've really been in full bloom and led the way. Cyclical stocks, things that are accommodating to an environment like we're in, more of an expansionary phase. So home builders, forestry companies, manufacturing companies, industrial companies, metals companies, things that would dovetail more to an expanding economy that's repairing bridges, repairing roads, putting up power lines, things like that. High yield bonds and intermediate term bonds have been attractive yield producing opportunities. Now, it's funny because it's almost a catch-22. These two types of securities, intermediate term bonds and high yield bonds, offer or provide investors with a certain amount of interest rate risk that if interest rates were to rise, these securities may be penalized or may lose value a little bit more than other types of fixed income securities. But as the Federal Reserve has continued to stay involved in the bond buying, stayed involved in the interest rate markets and the bond markets, these two types of fixed income securities have fared well. Going forward, you're really looking at high yield bonds, but intermediate term bonds again are probably a little bit more interest rate sensitive because of that lower coupon. And so as we look at some of these securities in full bloom, we may want to rethink our exposure today versus what we want to hold going forward. And that kind of leads us into the harvest time. Stocks that we don't think are positioned very well, or types of securities that aren't positioned very well for the environment that we're eventually leading into. So things like defensive stocks. Those would be like utility companies, power and electric companies, things like that, where they're highly regulated. There's not a lot of growth in those sectors. They're more used for income and less for growth. So we think that defensive stocks have more or less been played in most investors' hands, and the valuations are no longer as attractive as they've been in the past. High-quality bonds and long-term bonds. We think it's harvest time for these two categories for completely different reasons. High-quality bonds have been purchased and held by investors coming right out of the recession 2008. So the valuations on these bonds are very rich, and there's not a whole lot of yield that you're going to earn or return that you're going to earn from these types of securities. You're essentially paying for the safety of a high-quality company, a high-quality issuer. Long-term bonds host an enormous amount of interest rate sensitivity. The average long-term bond portfolio has a duration, which is a measure of interest rate sensitivity, of roughly 10.5 years, which means that for every 1% that interest rates rise, that long-term bond portfolio could potentially lose up to 10% in value based on the amount of interest rate sensitivity in the portfolio. So we think that given where interest rates are today and where we expect them to be, long-term bonds don't present a very favorable opportunity set for our investors. We also think investment-grade corporate bonds, similar to high-quality bonds, don't offer all that great of an opportunity as well. Again, you're paying for that high-quality name. You're paying for the safety in that name with the yield you could be earning in the investment. So going on the notion of our double-digit forecast return for stocks, we think it's a very favorable environment for stocks at the moment. We've seen stock prices rising almost steadily since 2009 with a small hiccup in 2011. But most of the companies in the S&P 500 continue to meet or exceed earnings expectations, profit expectations. And really what that does is it allows investors to shift their focus from what the Federal Reserve is doing to some of these individual names, individual companies that are actually performing well in this market environment. Our outlook for earnings growth on the S&P 500 is anywhere from a 5 to 10% growth in earnings. That means the economy continues to expand. So all that fear and negativity that's out in the market today is really being dampened by the fact that companies continue to perform well. And that's reflective in the stock price growth we've seen, and certainly one of the catalysts of why we think the stock market will return low double-digit returns this year. We put together a quick chart for everybody to look at. The green line represents the quarter-over-quarter earnings per share estimates for the S&P 500 and their growth rate. The yellow line represents the ISM Purchasing Managers Index, which essentially forecasts how businesses are going to spend their capital over the next 6 months. As you can see, as the ISM, with this yellow line, as the ISM forecasts on business spending increase, we saw a commensurate increase in the earnings per share growth of the S&P 500, which means when the ISM indicates that businesses are spending more money, that typically translates into more profits and more earnings per share growth for investors within S&P 500 companies. So if we look at the most recent forecasts, we saw, again, a slight tick up at the latter part of 13, early part of 2014. We see the forecasts, again, have started to turn. This downturn that we're looking at here is, again, that first quarter in 2014. The bad winter in the Midwest, the bad winter in the Northeast, it slowed spending, it slowed inventory building, it slowed business expenditures. So that tick up, again, we believe will translate into continued profitability amongst S&P 500 companies. Bonds, again, present a completely different opportunity set. Many of the broadly used bond sectors, like intermediate-term bonds, treasury securities, government bonds, mortgage-backed securities, have been bought up, and truthfully, yields have been compressed to the point where you're taking a lot of risk for a very little bit of return. Given where interest rates are, and again, where we believe they're going, we think that when you're looking in the bond market, for a core of your portfolio, it still should remain high quality, low volatility type investment products or fixed income instruments. But for that fringe on the outside of your bond portfolio, those, call it satellite positions, you should be looking in some of those alternative sectors within fixed income, things like high yield, things like floating rate. And there are certainly a lot of good investment managers out there that have built a business and built a track record on finding those, call them out-of-the-way fixed income securities that can help provide you some additional return, some additional yield, and diversify away from the typical intermediate term or treasury security. If we look at where interest rates have been since 1990, we're in a fairly stable interest rate environment, meaning there aren't a lot of shocks to the system at this point. A lot of the interest rate activity has been dominated by the Federal Reserve Bank. So when we saw shocks in interest rates in the latest recession, 2007, 2008. We saw shocks in interest rates over the tech bubble that burst in '99, or some of the savings and loan spillover from the early '90s. We're in a completely different environment where not only business owners but investment managers, investors can really look at the Fed and have a better understanding of what they're doing. There's a lot of communication coming out from the government right now about how they're exiting their bond buying purchases, what types of securities they're starting to taper first, and what are the second and third in line. There's also been a lot of communication and forethought into the Fed's view on interest rates, what factors they're looking into, things like unemployment, things like inflation. So while we think that there aren't a lot of opportunities in the fixed income market, and we certainly see some risks with interest rates, we're happy to say that we're in more of a stable environment today, and so we don't expect anything to surprise us around the corner. When we talk about alternatives to the bond market, where else can you invest that fixed income money? You don't want to buy Treasury securities or high-grade corporate bonds at a premium. You want to buy them at par or at a discount. And so you really have to look to, again, those fringe asset classes to get some exposure to other fixed income alternatives. Bank loans or floating rate debt, one thing I had mentioned earlier, real estate investment trust and real estate. Those have been fairly popular for income purposes over the past couple of years. Master limited partnerships, which are essentially oil and gas companies that are building pipelines and transporting energy products, not only across here in the U.S., but even overseas, also provide a nice income replacement and diversification benefit. We spent probably the majority of this call talking about where we've been and some of the things that we're looking at. We also spend a lot of our time at 401k Intermountain talking about when's the time to harvest. What are some of the things that we need to look out for? And so we draw on some intellectual capital from a lot of different folks, places like LPL, places like JP Morgan, places like BlackRock, to try to give us some signs as to things they look at, things they pay attention to in different economic cycles and different market environments. And there's really a few different things that they look at. They look at the overall market. They look at the opportunity set that's out there. They look at fundamental indicators. Are earnings increasing? What are the other indicators saying? What are the GDP forecasts? We look at valuation. So based on where we think our fundamentals are we paying too much or are we paying too little for investments? Are we buying things on sale or are we buying things at a premium? We look at technical strength. So what are other investors doing? Is there a lot of volatility? Is there a lot of buyers and sellers? Or are there more sellers than buyers? So we'll look at some technical factors, and then we just get sentiment. Are businesses expanding? Are they buying more goods? Are they restocking inventories and creating new product? And are consumers buying more? Consumers represent 70% of the GDP number. So 70% of gross domestic product here in the U.S. is comprised of purchases from you and I. And so we need to know consumer sentiment. Are they buying more? Are they buying less? Are they hunkering down for the winter? Or are they going on vacation? So if we look at the thermometer for each one of these different factors, all of them, aside from valuation, seem to be in line and at a fairly comfortable level. Again, valuation really stems from a good economy. We've been working through, although it may not feel this way, we've been working with a fairly good and stable economy for the past 3 to 4 years. And really what that's allowed investors to do and consumers to do is to slowly step into the market as they feel more comfortable, as they see companies earning more money, as they see the Fed become less intertwined in our investment markets. People start to take cash off the sideline and invest the way that they typically feel is best for them. So we see valuations rising. It's a sign of a good market. You're probably watching on the news or hearing on the news that the Dow Jones Industrial Average or the S&P 500 index, they're reaching or kissing or towing new lines every day, new highs. And that's true. So that's something that we're cognizant of and we're certainly concerned of, is that we don't certainly want to pay up for investments too much, but at the same time, because of the benefit you have in the 401k, you're dollar cost averaging. So you're not always buying at the highs, you're not always buying at the lows, and you're buying at a smooth, regular average. So with that, I'm going to pause a second for questions and see if, based on what we've said today, or again, based on what you've experienced out in your own world, are there any questions from today's presentation? Is there anything that's on your mind that you'd like to ask us? Brady, Corby, I'd love to open it up for some questions.
Yeah, I've got the question and answer tool opened up. If anyone has any, feel free to type it in. You can also raise your hand, and I can click on that and unmute you if you prefer to ask it in person. Looking like a quiet group out there. We have recorded this session, so we'll be providing it to all of you via email. And if you have any questions for us or Patrick, of course, just feel free to let us know, and we'll be happy to answer those. We look forward to reviewing more of these materials that Patrick and our investment team create at any of your upcoming quarterly or semi-annual retirement plan reviews.
Okay, guys, thank you so much for taking the time. Pat, we appreciate the quality of the information and the presentation, and we will be emailing this out to each of you so you can, a recorded version, so you share it with your colleagues. Did you have one question, Brady?
No questions. So thank you all for attending, and I look forward to seeing you soon.